Welcome to Part 2, Financial Statement Analysis. We will be looking at vertical analysis for this section. The vertical analysis is also called common size analysis. The reason for this is because you take the entire statement, whether it's a balance sheet or an income statement, and you put it into a percentage. You eliminate the numbers and you put the whole statement into percentages. Well, you don't eliminate them, you show them there, but you analyze the statement on its percentages. So you have to have a basis for each statement. The basis changes depending on the statement. For the balance sheet, the basis is total assets. For the income statement, the basis is net sales. So let's show an example. Let's start with Kellogg's again. Let's look at the income statement. We have same periods, fiscal year 2009, 2008, and 2007. So let's look at these trends. Now before we do that, let's point out that each of these years stands alone as a vertical analysis. So the 100% figure in 2009 is 12,575, and gross profit is compared to that, and you get 42.87%. In 2008, the 100% figure is 12,822. Gross profit of 5,367 is compared to that year's net sales, and you get the percent. So you can see here, if we look at the trend in gross profit, it was almost 44%. And here it's dropped 2 points. And it's recovered a little bit here. Operating expenses have improved. They've lowered as a percent of sales here, almost 2 points, 2 percentage points. They rose slightly over here. Net income dropped in 2008 and recovered in 2009. So let's review that calculation. Operating expenses in 2008 were $3,414. They're compared to net sales for 2008, and you show that they represent 26.63% of net sales. Okay, so looking at this income statement, and I went ahead and added cost of goods sold here just because I think it's interesting. As a review, gross profit is equal to net sales minus cost of goods sold. So you can't analyze sales because they're always the 100% number. In order to analyze the sales trends, you really do have to do the horizontal analysis. But you can look at the other numbers. Now, I like to start with income. Did we make money or not, and how does it compare? So you can see net income as a percent of sales increased in 2009 compared to 2008 and also compared to 2007. So we have an overall positive trend in net income. The improvements in net income were caused by reductions in operating expenses. Now look at that. We talked about that. We dropped almost 2 points in operating expenses, and we rose a little bit here, but basically we're still down at this level and not up at the 28.12% level. And so that caused improvement in net income. Gross profit worsened in 2008. It was strong in 2007. It went down, but we've recovered almost a full point here. All right, let's look at the balance sheet. Now the 100% figure is total assets, so everything is a percent of total assets. And this is not a complete balance sheet. We have some treasury stock, and that's why these numbers don't add up. These are just pieces of it. And so every year the total assets number stands alone, and you can see how current assets is getting to be a smaller percentage of total assets. Current liabilities has also gone down. Total liabilities has increased in 2008 but gone down again in 2007. All right. Again, reviewing these calculations. Total liabilities for Kellogg were 26.63% of total assets in 2008. Be sure you understand all of that for the all those calculations, both for horizontal and for vertical analysis. The bigger and probably the more challenging part of financial analysis is the written part too. So go back and review how I wrote these analyses and remember to add in a paper or a test situation evidence, numbers, and percentages. So let's go back and use some analysis to look at Kellogg's in the years 1997 and 1998. This is a vertical analysis. So you see net sales is 100%. Net sales is 100%. So the question is, what trends do you observe? And so what we want to look at is, what are the gross profit trends? What are the sales and administration trends? And when you see a big dip like this, 2.7 to 1, go ahead and look at the dollars and say, well, yeah, that is a big dip, but it's a small number compared to our total number, our total sales numbers. So we really want to focus on some of these bigger numbers here: income before income tax and net income. So I'm not going to give you the answers to this. I'll give it to you at the end of part 4. But there was an event that occurred in the marketplace that Kellogg did not respond to. And so this caused this trend in its sales, in its income statement. So what you want to do is go back and look at that income statement for 1998 and 1997. Go back to that previous slide and ask yourself, what is the trend in those 2 years on sales? If sales is going up, then cost of goods sold should follow that same trend. If sales goes down, cost of goods sold should go down as well. If it doesn't mean that there was a mistake made. It just means that you as a manager would ask the question, why? You also want to look at other costs as a percent of sales. And just so you know, the selling and administration would include things like promotions, giveaways. In cereal boxes you might have toys or prizes. You might give discounts to Safeway or Albertsons to put your cereal on a certain level. Those are called slotting allowances. Marketing, advertising, television would be all in that selling and administration. Okay. And again, remember, in your written analysis, you may not know the reason. You probably don't, because you're looking at a statement for the first time. But you want to ask questions. Why did this go up if sales went down? Why didn't this go up if sales went up? So this is where you really look at what's going on the statement over time. And putting vertical analysis is kind of nice because it kind of equalizes everything. It allows a very large company to be compared with a very small company because everything's a percent of sales. This concludes vertical analysis part 2. Let's go on to part 3.